Welcome to This Explainer. Today, we're going to completely demystify a financial engine that literally keeps cooperatives thriving, the Education and Training Fund, or ETF for short. We're going to track the life of this fund from the very first peso of surplus all the way to the final ending balance at the close of the accounting year. By the end of our time together, you'll see exactly how the numbers flow, logically and, honestly, quite beautifully from one ledger to the next. Now, to make sure we're keeping things grounded in the real world, we're going to use the official cooperative accounting framework provided by MFR Bangsamoro. That's the Ministry of Agriculture, Fisheries, and Agrarian Reform for the Bangsamoro Autonomous Region. It's incredibly valuable to use this specific institutional context, really because it provides us with a rigorous, standardized approach to cooperative accounting. So we aren't just looking at some abstract textbook theory today. We're taking their rigorous standards and applying them to a full-cycle, advanced case study. Okay, let's dive into this. How do you actually account for a cooperative's education and training fund from its inception, as just a slice of the initial surplus, to its final balance after all the bills are paid? Now, I know it sounds like a totally daunting financial puzzle, especially if you're newer to cooperative accounting, where funds literally have to be strictly allocated by law. But as you're going to see, when we break it down into a structured process, it's really just a sequence of logical, highly organized steps. Our financial story kicks off with this one powerful number, 300,000 pesos. This represents the cooperative's undivided net surplus at the end of the operating year. You can think of this as the grand total of the cooperative's earnings before any of the mandatory statutory funds have been carved out. It's the entire pie, basically, just waiting to be sliced. And absolutely everything we do from this point forward hinges on this exact starting figure. So let's look at the puzzle pieces we get to work with for our case exercise. We know our starting net surplus is 300,000 pesos. From there, our task is to compute the education and training fund accordingly. But hey, a fund is meant to be used, right? So during the year, our cooperative incurred two distinct expenses. First, an agriculture training expense of 8,000 pesos, which, makes perfect sense for an agricultural cooperative trying to upskill its members. Second, a governance training expense of 5,000 pesos, just to ensure the board and officers are operating as effectively as possible.
Now, to properly reconcile the cooperative's books, we can't just fast forward to the end. We really need a clear roadmap to prevent any sort of financial mismanagement. The MAFAR framework actually outlines 5 exact requirements we have to fulfill to complete this cycle. First up, we compute the ETF. Second, we formally record that allocation. Third, we record the actual training expenses as they hit. Fourth, we perform the crucial step of closing those expenses out to the ETF itself. And finally, step 5, we figure out the ending balance of the fund. 5 clear steps to total financial clarity. Let's do it.
All right, let's tackle step 1, computation. Out of our 300,000 peso total undivided surplus, the cooperative framework dictates very specific percentage allocations. First, we have another required allocation, the Cooperative Development Fund, which takes up 30,000 pesos. But following the statutory formula, our primary target, the Education and Training Fund, is calculated to be exactly 15,000 pesos. So this 15,000 pesos is our absolute maximum allowable budget for education and training for the year, based on the surplus. It is literally the lifeblood of the cooperative's capacity-building efforts.
Now, what's really interesting about this next part is how we translate that concept into an actual accounting reality for step 2, the allocation entry. We debit the undivided net surplus for 15,000 pesos. Why a debit? Well, because we are actively reducing the overall undivided surplus pie. Then we credit the Education and Training Fund for 15,000 pesos. By crediting the ETF, we are officially parking that money into a designated liability or equity reserve account. It is safely ring-fenced. And this is vital, right? Because it protects member interests and ensures long-term cooperative growth. It absolutely cannot be used for general operations anymore. It is strictly locked in for education and training.
Let's fast forward a bit into the operating year. The cooperative is actively holding its seminars. Remember those facts from our case? We had 8,000 pesos spent on agriculture training and 5,000 pesos spent on governance training. Connecting the dots here is simple but totally necessary math. We just combine these to find a total training expense of 13,000 pesos. This represents the total value of the educational services the cooperative actually consumed. And this brilliantly illustrates what we do for step 3, which is logging that reality into the cooperative's day-to-day books. We record the expenses by debiting the education and training account for 13,000 pesos. This recognizes the economic cost of the training we just did. On the flip side, we credit cash for 13,000 pesos. This is the hard cash actually leaving the cooperative's bank account to pay the trainers, rent out the venues, or buy all the materials. Let's move on and see how this all builds up, which brings us to our fourth step. This is honestly the most critical accounting maneuver in fund management, closing the expenses to the ETF. See, at the end of the year, we really don't want that 13,000 pesos just sitting around in a temporary expense account. It needs to be absorbed by the fund we created specifically to pay for it. So we credit the education and training expense for 13,000 pesos, effectively zeroing it out completely. And where does it go? We debit the education and training fund for 13,000 pesos. We are actively drawing down that ring-fenced reserve we established all the way back in step 2.
Which brings us to the grand finale, Step 5, determining the ending ETF balance. It's a very simple reconciliation, and the math checks out cleanly. We started with an allocated fund of 15,000 pesos. We utilized and closed out 13,000 pesos in legitimate training expenses against it. So 15,000 minus 13,000 leaves us with a neat, precise ending balance of exactly 2,000 pesos. And the best part? This remaining balance isn't just lost. It stays right there in the fund, rolling over to support even more future educational initiatives for the cooperative's members.
And there you have it. That completely demystifies the full cycle of the Cooperative Education and Training Fund. By strictly following this framework, a cooperative ensures total transparency and accountability for its statutory funds. But before we wrap up, I want to leave you with a proactive thought. Looking at this remaining balance, how will your cooperative utilize its 2,000 peso fund next year? Because at the end of the day, accounting isn't just about recording the past, it's about giving you the exact data you need to strategically plan for the future. Thank you so much for joining me on this explainer. Keep learning, keep organizing, and I'll catch you next time.